Good morning, good afternoon, and good evening to all of you who are joining us. Welcome to the Evershed Sutherland Clean Energy Team's 2021 webinar series, which we're calling From Transition to Transformation. I'm Dorothy Franzoni. I'm the chair of the Evershed Sutherland US Clean Energy Team. I'm a transactional lawyer, and I focus on renewable energy project development in the US electric industry. Evershed Sutherland is a global law firm. We have over 3,000 lawyers in 68 offices across 32 countries, across Africa, Asia, the Middle East, Europe, and the United States. Our clean energy team comprises over 150 lawyers covering all legal disciplines related to implementing clean energy strategies, including commercial, regulatory, and finance issues. This webinar is the first in a 6-part series that we're doing in 2021, focusing on the transition to a lower carbon future. The need for this transition is becoming increasingly clear and much more widely accepted than ever. As you all may know, the average global temperature is now 1.1 degrees centigrade higher compared to pre-industrial times. And even in the years 2015 to 2019, there's been a 0.2 degrees centigrade increase compared to the previous 5-year period. This has already led to a notable increase and worsening of extreme weather events, such as flooding and bushfires, and poses a significant threat, especially to low-lying nations, particularly island states, due to rising sea levels. So we felt it important to focus this year on what is going to be happening in 2021 as we begin to seriously undertake the efforts to transition to a lower carbon future. This first webinar will be a focus, an overview of the upcoming events for 2021 in this arena. And then in March, we will do a session on financing the energy transition. In May, we will focus on technologies needed to accelerate the energy transition. In July, we will focus on corporates and the best decarbonization models for corporate entities across all industries. In September, we'll talk about decommissioning and end of life for carbon-based energy assets. And then in November, we'll do a bit of a look back at lessons learned in 2021 and perhaps a little prognosticating as to what's to come in the future. But for today, we're focusing on a look ahead for 2021 with an overview on what the clean energy transition will look like in 2021. The format for today is that we will have a keynote speaker and then a panel discussion to dive into some of the things touched on during the keynote. We welcome your questions. We would really like for this to be an interactive session with you. So please, as our keynote speaker is speaking and as the panelists are discussing, please submit your questions using the Q&A function, which you should find toward the bottom of your screen. And we will do our best to answer your questions, and you can help guide where we take our panel discussion today. So please do participate. So let me first introduce our panelists. Again, I'm Dorothy Franzoni. I will be moderating our panel today. I'm a partner in the Atlanta office of Evershed Sutherland, and I focus my practice on renewable energy transactions in the electric industry in the US. Also joining us, and I'll ask our panelists to just give a little wave as I introduce each one of them. Joining us as well is Michelle Davis, who is a partner in the Evershed Sutherland London office, and is the international head of the Evershed Sutherland Clean Energy and Sustainability practice. Michelle's focus is on corporate strategy within this sector, including M&A, equity raising and investment, and exit mechanisms. Mark Herlock is a partner in the Evershed Sutherland Washington, D.C. office, and he leads our nuclear energy team and is the global chair of the Competition and Trade Group. He advises clients on a full range of low carbon and energy transition issues, including commercial, policy, and regulatory matters. We are especially grateful and honored to have with us today for our keynote speaker, Ilesh Patel from Baringa Partners. Baringa Partners is a management consulting firm that helps their clients run more effectively, navigate industry shifts, and reach new markets using deep industry insights and innovative ideas. Baringa has been voted the leading management consulting firm in the Financial Times UK Leading Management Consultants 2020 in the categories of energy, utilities and the environment, and oil and gas. Ilesh Patel is Baringa Partners Global Strategy and Markets Lead for the energy and resources industry. He has over 25 years of global experience and has been at the forefront of the energy transition landscape, advising the full spectrum of stakeholders from utilities to regulators and governments, as well as lenders and investors across the low carbon value chain. We are very appreciative to Ilesh today to have prepared for us a really interesting, comprehensive overview of clean energy transition for 2021. So I'm going to turn it over to him to give us a brief keynote to start this discussion. Again, to the audience, please feel free to submit your questions using the Q&A function, which you should find hovering your mouse toward the bottom of your screen. And we will do our best to pick those up during the panel discussion. So over to you, Ilesh.
Thank you, Dorothy, for that very warm welcome. It's an absolute pleasure to be here today virtually with you all. And thank you to Evershed Sutherland for hosting this event today. Evershed Sutherland is a hugely respected firm in the low carbon space, one that we at Baringa Partners work with closely, hugely respect the work you do and actually love working with you. So an absolute pleasure to be able to give this today and to be invited to do so. Let's get into this. I think my starting point today, apologies, I need to go back. Sorry, apologies, slight technical issue, it's going to go back. Our low carbon future is here now. 2021 is the inflection point, and one may look no further than the green agenda being top of the priority for the new US administration. The most significant climate change summit since Paris will be happening this year in October in Glasgow. The growing political support for net zero carbon targets across economies in Asia Pacific, investors, banks embedding climate change into decision making that they're making both around lending and investment portfolios, initiatives from the Bank of England and the UK, for example. Mark Carney's initiatives and thought pieces around this are really driving a fundamental shift in both the financing and investment community. And then no least the turning point that we've seen this year around oil and gas majors and corporates. 2020 year was the year of net zero pledges. I think none of us could turn off the news or look at the news for more than a day without seeing a new pledge around net zero. And so now is a time to begin that kind of strategic and operational focus for those companies. 2021 will be the year with those fresh government commitments from the top emitting countries, the imminent approach of COP26 and a real private sector focus and company focus on embedding climate change into investment decisions. 2021 has to be the year of action. And yeah, that may sound optimistic, but it's also comes with a warning. Our generation will be the first to feel the full impacts of climate change and the last to be able to do anything about it. So 2021, in my view, must be the year when transition becomes transformation, where we need to deliver on those commitments, those net zero commitments and promises we have made, and build back greener in a difficult environment, which we know we're currently in with COVID as it continues. If I look at how we build back greener, I think the first thing I'd say in terms of 2021 is we must look at a low carbon future that goes beyond power renewables. And the really important piece of this is that 80% of our emissions comes from sectors outside the power sector. So the transport sector, buildings, end users, corporates will be critical to our low carbon future, and any participant in the energy value chain, whether you're a financier, an investor, a utility, an advisor, must be thinking about what's happening in the three major sectors outside of power that I've listed here. And for each sector, we need to be focusing on the decarbonising choices ahead of us, whether that includes renewables, whether it includes hydrogen, thinking about carbon pricing, electric vehicles, low carbon heating, storage, clean energy certification, All of those are going to be critical facets of achieving our low carbon future and making the choices ahead of us. And some of those choices will be easier than others. There are some very hard to decarbonize parts of the transport sector, as we know, air, for example, or aviation, for example, and some very hard to decarbonize facets and parts of the buildings and industry sectors. And so the choices here are not straightforward. What we do know is this will require trillions of dollar investments, by our estimates, $11 trillion worth of investment to transform all four of these sectors over the next 15 to 20 years to get to that, put us on a pathway to the net zero world. All of that needs to be achieved in the context of a sustainable finance mechanism, which is viable, but also an economic development and sustainable finance ecosystem, which lives and breathes together, so that we aren't making the trade-offs between economic development and sustainable finance, that they come together to enable us to make the changes that we need to do and embrace that low carbon future across all the energy vectors that we need to make those changes in. But the choices do need to be made, and they need to be made today. One of the important things that I always emphasize when thinking about decarbonisation is the lead times for energy infrastructure, which Mark, Dorothy, and Michelle will talk about no doubt in the panel, are very long. So the decisions need to be made now, and those will have an impact in 2030 and in 2040, and we can't afford to wait. So let me give a perspective on what those decisions are. What are those things? What are those trends in 2021 that we need to make decisions on, or that are going to shape 2021 and therefore the next 10 years of our decarbonisation and low carbon future journey? Well, first of all, financing structures, up on the top left of this slide here. I think the innovation of financing structures, the influence of TCFD and risk and regulatory reporting drives. We all saw BlackRock's and Larry Fink's letters to both CEO and clients yesterday. How important is that going to be in driving behavioral change amongst investors and lenders? But equally, the innovation around financing structures that needs to happen around green bonds and alternative financing structures that are going to allow the decarbonisation of industry and not only the financing of renewables. I think we've done a really good job as an industry on financing of renewables, but where do we go from that so we can decarbonise transport, buildings and industry? I think there's something about clean energy certification as well. What is that gold standard? I think that we need to search out for renewable energy certification offsets that are going to make the pricing and value of the renewable energy we produce in order to meet our net zero objectives really valuable and traceable. Something for me, thirdly, around the next generation of renewable energy, as I've called it. What is that model, that business model, which markets should we focus on that are going to be the next wave for the next 10 years of where the renewable energy itself and industry needs to focus? I think there's something around the oil and gas majors transformation. Are they really going to deliver? This year's 2021 going to be the year when they commit from promise, which they've done last year, into action this year? And where does that investment happen? How will it happen? How quickly will it happen? Turn a little bit to technology, hydrogen. I probably classify myself as a moderate skeptic on hydrogen, or have done. But is 2021 the year when hydrogen will come of age and become commercially scalable and be adopted en masse for certain use cases? One that's often missed is clean tech manufacturing. There's a lot of attention given to battery storage, and particularly some of the gigafactories turning out battery storage. But I put equal weight on electrolyzer factories or on large turbine factories. The next generation of OEMs and clean tech manufacturing and international trade, I know something that Mark will touch on later, will be really, really important to driving that low carbon future. Building platforms, investors don't like investing in 2 megawatt projects when they've got billions of dollars to invest. So what will the future of renewable energy platforms look like in 2021? And I think it will be another year when they will be important across the world. And then finally, corporate decarbonisation. The major technology players and the likes of Amazon and the RE100 companies, now 250 of them are signed up for that, have already set the pathway for corporate decarbonisation. But will they really scale in 2021? I think that will define where 2021 takes us. Why don't we double click then into 3 of those areas? And I think there's 3 messages here as I double click on 3 of those 8 areas. Firstly, global renewables will be the bedrock of a low carbon future. Let's not think renewables are over in our passion to go after storage and hydrogen. 80% of our effort may well still need to be in renewables in 2021 and in the next 10 years. But a low carbon future cannot be achieved without decarbonizing industry. So as a second double click thematic. And then finally, decarbonizing industry, we can't achieve it because it's really hard without finding new technologies such as hydrogen, which can help that decarbonization. So I think for 2021, I'd say the focus needs to be on these three. And let's just spend a minute or two exploring each of those. So in global renewables, I think the focus for 2021 needs to be on scale, route to market, and project information to achieve improved returns for projects and entering new markets and countries, especially if you have 2030 goals. And for those that have 2030 goals for capacity or capital to be deployed, you're already too late for greenfield development. M&A will have to be the answer for you because of the lead times of developing from greenfield new onshore wind and new offshore wind projects. May still be possible for solar with shorter development times, but certainly for new opportunities deliver capacity by 2030, you're too late if you're starting greenfield now for most mature technologies at scale. On the onshore wind side, I think 2 or 3 of the big issues to focus will be on high load factor renewables. Types that we're building in the Nordics, in Europe, in Australia, several hundred megawatts in size in Texas, both on solar and wind. Those are the projects that I see investors really focusing on 21. Where can we find those really big, super scaled projects that can allow us to deploy large scale capital? There'll be some really important priority markets for that. US and China and Europe will continue to be important, but within those, some sub markets could be really interesting. I think Poland as a new hub, the North Sea in Europe, Australia particularly continues onshore wind and solar to be important. Southeast Asia will grow, and India for certainly renewables, as we saw with Total's deal with Adani, is going to continue to be an important focus for international investors. And additional value creation will happen through business models such as bundle storage or optimizing your route to market, which includes merchant or even long-term PPAs through corporate PPAs, for example. And on the offshore wind side, which has been incubated in Europe and now going global, the hubs will be largely similar to 2020, but I think again, they will reach scale and there'll be further opportunities for new hubs to emerge. I mentioned Poland already. One of the areas I think that is going to be really interesting is how you scale floating wind, which is to come, and grid optimization for offshore wind. The world of point-to-point grid connections, which can often be up to 1/3 of the capex offshore wind, may well be diminishing as a value point, and there may well be value for developers to focus on coordinating grid connections to reduce the price of projects over the 2021 period as they look to design projects that are going to deliver over the next 10 years. If I turn briefly then next to decarbonizing industries, I think the 3 or 4 most important industries we need to focus on, and that are the front line of the energy transition, are going to be oil and gas, particularly refineries, heavy industry, and tech and data centers. If I pick 3 sectors to focus on this year, it's going to be those 3. And in all cases, the renewable energy will play a really important role on the energy purchasing strategy side. But in all 3 of them, we also need to look at the intrinsic nature of their operations. What are their energy requirements across heat, light, power, conversion technologies, and what of new technologies on transition side, like hydrogen or CCS, can play an important role now in helping to decarbonize their operations. And then to help them, I briefly mentioned hydrogen there. I think hydrogen and CCUS, or carbon capture and underground storage, is going to be critical to reach net zero, particularly in those hard to decarbonize sectors. There are going to be some really important barriers that remain to that, both in economics and non-economic barriers. But I think there are some really attractive use cases that are worth investigating. And as investors on the call, I think you should be focusing this year on looking at and starting to diligence specific use cases which could reach commercial viability in the next 2 to 3 years. And I think I would focus on 3 particular use cases: ammonia, refineries and petrochemicals, and in steel, where I believe, depending on your view of carbon pricing and the impact of carbon pricing on those operations in different countries, in a scenario where carbon prices start to, and carbon price exposure starts to rise above the $50 a ton mark, the economics of hydrogen can look very attractive, particularly where you can produce green hydrogen using low-cost renewables. And I think there's 4 or 5 countries around the world and regions around the world where that could be interesting. Australia, I think some parts of the US, offshore wind in Europe, I think could be really interesting, and in some parts of China as well, where for transport, they will particularly focus on the downstream market, but the low-cost renewables will really help them. So I think the recap for me is 2021 is the inflection year for us, and we need to act this year because the next 10 years will set us on a pathway to the next 40. And I would focus this year on the 8 trends that I think will define that, and in particular on 3 areas that I think will be able to impact where investors focus and where we focus in the industry. Renewables is a bedrock, decarbonizing industry, and supporting the commercial scaling of new technologies such as hydrogen to help both of those. Thank you. And Dorothy, I think I'm handing back to you. Dorothy, I think you're on mute.
Sorry about that, everyone. Thank you, Ilesh. That was fantastic. Really appreciate that great kickoff to this webinar series. So I wanted to start first with a few questions to the panel on areas of finance. And I do have a couple of questions from the audience, which we're also going to get to. And again, a reminder to the audience to please continue to submit questions using the Q&A function. So first, I wanted to talk a little bit about, as Ilesh pointed out, there's a lot of investment required to make this transition. So let's talk a little bit about some areas relating to that. And as in many areas, cross-border investments are going to be, play a large part in the energy transition. And so I wanted to start by asking Mark, what role do you see countries' trade laws playing in supporting or hindering investment in clean energy? And what about foreign investment restrictions in addition to just trade laws in general?
Thanks, Dorothy. There's actually quite a lot to talk about here, and I'm going to focus on 2 things, which is, in the first instance, the foreign investment laws, and then how the other trade laws could actually be used to serve climate change goals. On the foreign investment front, the U.S. has for some time had a procedure operating under a group called the Committee on Foreign Investment in the U.S., or CFIUS. And that particular set of procedures has been used to ask the question, do we really want a foreign investment in a given critical infrastructure? Now, this started with a focus on national security, but it's expanded in recent years to really impact a lot of inbound energy investments in the States. And the thing to keep in mind here is it's not really an absolute bar, but it does mean for those of you on the call who are thinking that you may want to invest in U.S. energy infrastructure, you just need to keep in mind that depending on what you're trying to invest in, you may have to deal with this particular set of procedures. In a number of cases, this has proven to be a barrier for people's commercial objectives. But primarily going forward, it's going to be an issue for inbound investors with Chinese interest, because that's really what the current targeting is. Lest you think that this is just a U.S. problem, I can tell you that this is a U.S. export. And right now, what we see in a number of other jurisdictions, particularly in Europe, is increased emphasis on this. So, if you're looking at the trade picture, I think that's clearly something that everybody needs to keep in mind, because the UK, Italy, the EU and other jurisdictions are now asking the question, do we want this particular foreign investor and these particular foreign interests to take ownership of some of our critical energy assets? In a totally different context, we've got the trade remedies laws, and they've had a somewhat mixed effect, at least in the United States and Europe, on the development of renewable energy. And here I would just draw your attention to the solar panel anti-dumping and countervailing duty actions, which have shaped in many respects some of the economics of the solar rollout in both Europe and the US. And in those particular instances, we've seen a split in the industry because you've got, on the one hand, people who are seeking to protect domestic producers of solar components, and on the other hand, interests that say, gee, it's great if we can get this stuff made cheaply in China because it makes it more cost effective for us to roll things out. So you've got that issue, but I'd like to raise a third point for people to think about, and that is, how can we make the trade laws actually support climate change? And what we're going to see, I think, in the coming months is increased emphasis on what do you do about carbon issues as goods cross borders. And what I mean by that is there's going to be a discussion about whether or not we can use some of the trade laws to penalize producers in countries that do not subscribe to appropriate carbon goals. So that's just a trend to keep an eye on.
Great, thank you, Mark. And I want to follow up on a question that has come in from the audience around innovative financing for the clean energy industry. And so the question is really, you know, how do we see these projects being financed in the future? Will people rely mostly on historic models, or will there be, you know, innovative financing instruments, you know, even beyond green bonds? And in particular, you know, are there instruments at the moment that are only available for EU investments as part of the EU's Green Deal? Michelle, can you speak to some extent to, you know, what's going on in Europe and what you're seeing in other parts of the world with respect to investment vehicles?
Yeah, sure. I think in my view, one of the biggest growth areas we're going to experience is with corporates needing to decarbonize. And Ilesh picked up on some of the sectors where those companies are going to have to go on an energy transition. And we've had some questions from the audience about just how do some of those companies do that? How do oil and gas companies, for example, what's the best route for transitioning? But I think generally corporates are going to be transitioning because they're going to have to be doing an awful lot to stand behind some of the statements they're making. And that means that the finance for all of that has got to be found somewhere. And I think we'll see a significant growth in energy transition bonds, climate bonds, whatever you want to call them, or whatever their purpose is for. But I think we'll see a big growth in those, and they will be at the corporate level. And they're different to sort of the green bonds that we've seen raised by governments to date. This is very much at the corporate level. I also think that we'll start to see, and going back to the point that Ilesh made around investors needing scale and needing to do things at size, and also to the other point that he made, which was around the need to access the higher returns, which is predominantly through more merchant and C&I offtake arrangements. I am thinking very much of power now, renewable power, but you know, in many markets around the world where it's quite difficult to get those scalable projects, possibly because the government that has historically procured them is maybe not bankable, and therefore you are going into these C&I merchant opportunities. You need to package them together. And so so there is I think going to be a growth of securitization of funding that is going into these projects, but that will depend on a workable debt capital market within the relevant country, and that isn't always the case. So I think we will start to see those kinds of structures emerge. We're also seeing a number of banks creating products for companies themselves to invest in, so that they can use that as a means of, if you like, reducing their carbon footprint and showing that they are investing sustainably and are able to do that. I think Larry Fink mentioned this in his letter yesterday, that, you know, the various organisations that are putting these together are able to put more bespoke solutions for the investor together. So there's an awful lot that's going on. In terms of what's happening in Europe, there is the green bond that and the criteria for that has been launched by the European Commission, and you know, the expectation is that that will be a growth market. But I think there's an awful lot more going on, and I would imagine that in 5 years' time the way the projects are financed will look a little bit different to the very traditional models that we've experienced so far.
I think that's spot on, and I don't know, Dorothy, if I could follow up on that. Just one
Please,
additional point.
yes.
That's a great build from Michelle on that, which is, I think the super large projects we're seeing, you know, the 2 gigawatt, 3-4 gigawatt offshore wind projects, the 500 megawatt solar projects, will require two things. They'll require a more JV structure, almost back to the early oil and gas days, where you had JV structures at the outset or very quickly into development, which do bring, you know, risk diversity within that project across different shareholders. I think you'll see more of that across the world, actually, as these projects start to get developed and scaled. I think the other thing that Michelle mentioned was the sustainable finance bonds, and these are corporate bonds. You know, Tesco's just issued 750 million bond, which is linked not to a project, but it's linked to its sustainability goals. You know, and it's using that to drive supply chain improvements. I think there's some innovation there. And one more that I'm seeing out there is credit support, particularly for lesser credit when it comes to offtake for renewables. You know, I think you'll start to see some credit support innovation happening, whether it's multilateral institution driven, yeah, so in European Investment Bank or a World Bank driven, you know, framework to do that, to enable some of those lesser credit off-takers with projects with lesser credit off-takers to get out and get done.
And I think, Ilesh, that's a really key point, because, you know, where a lot of the growth is in the merchant C&I space, and that credit support is going to be essential. It's really interesting that you mentioned DFIs, because I know that that is very much an area of their focus now.
Exactly.
Michelle, you mentioned C&I, the consumer. Let's turn our attention a little bit to, you know, just the ultimate consumer here, and what will there be sort of a battle for the consumer's attention? You know, how do you think this is going to impact the actual delivery of energy to the ultimate consumer? And what changes do you see coming in the future that, you know, for ESCOs or others in delivering energy to the ultimate consumer, whether at the commercial or at the retail level?
So I think this is a really important question. And again, it in part goes to answering the question around how do oil and gas companies transition, because a big part of a lot of oil and gas companies will be their trading side. And a number of them have already started to access the power trading space and are focusing on renewables. And what I've been seeing for the last 3 years, but it's hotting up now, is a battle for the consumer, whether the consumer is an industrial or a residential. Because if you think about how we live, if we think of our home now is going to be very much a producer and storer of energy, as much as we are a user of that energy. And we're starting to see a number of organizations really compete to acquire utilities, and that's one of the most, you know, attractive forms of investment at the moment, so that they can own that customer relationship with a view to owning the assets that are within the relevant property, whether it's commercial or whether it's residential. So they would own the charging infrastructure. They would own the battery charging infrastructure. They would own the battery, the solar panels, the energy efficiency systems, and be charging a flat fee in return for a cash flow that is then capable of securitization. So this is a model that I think we're gradually seeing more of, and it is an area which we are seeing a number of the oil and gas companies move into. So yeah, I think that's a good question to ask, Dorothy. It's something we're seeing a lot of.
Absolutely, and I know here in the U.S. we're seeing increasing interest among the gas industry in transitioning to various biofuels and greening up, if you will, their natural gas offerings and in all sorts of ways. California in particular has some innovative programs going, and we've seen a lot of interest from investors in investing in biofuels here in the U.S. and continued strong support from the U.S. government for credits and other things in support of that. So I do see as well an opportunity in the natural gas industry for decarbonizing, the product, if you will. So I wanted to turn again, maybe a little bit to back up a little bit into some policy considerations. I know we're all excited, interested to see what the Biden administration is going to be able to accomplish. And I wanted to ask Mark about his thoughts on, the Biden administration has made clear they have 4 main priorities. One of those is climate change, and they've already begun to take some actions in that regard. But what changes do you see, Mark, in energy policy here in the U.S. that you think may drive changes in investment even in 2021?
I think there are 3 key things to watch for. First of all, as we've already seen, there's an emphasis on decarbonization, and climate change is one of the 4 pillars of the Biden campaign and of now the Biden administration. So from that perspective alone, you're going to see the president using his authority in a way that we've not seen in the last 4 years to advocate for decarbonization. And that's a powerful force, and I would anticipate that we're going to see a lot more activity in that. A couple of examples of how far that's likely to go are number 1, the appointment of John Kerry as a climate envoy. This is something that Kerry's committed to, and given his stature, I think that tells you volumes about where this administration is likely to go. The second thing I would point to is the emphasis on international cooperation. Obviously, the U.S. immediately is rejoining Paris, but Ilesh talked about COP26 later this year in Glasgow. That's going to be a focal point, and I think the U.S. administration, will now be an active participant in that, and that's certainly important. And then thirdly, there's going to be a series of domestic measures, and we've already seen some of that. People on the call may be aware that just this week, the acting Secretary of the Interior imposed a 60-day moratorium on leasing on federal lands. This is provoking a lot of commentary here in the States. The American Petroleum Institute has already taken a few swings at this, as have senior Republican leadership. They sent a letter to the president a few days ago, but I think it emphasizes just how committed this administration is going to be. You look at it, they've only been in office a week, and yet they're already moving forward on this front. So, given the size of the U.S. economy and the role that the U.S. plays in the world, I think it's going to have an impact in a lot of different contexts, both domestically and internationally.
Yeah, I wanted to ask Ilesh or Michelle, any sort of preliminary thoughts that you're seeing from clients about the change in, or the change in the administration here in the U.S. and efforts that people believe now may be more possible than had been in the past to collaborate on climate change initiatives?
Ilesh, do you want to go first?
No, why don't you go first, Michelle? I'll let you.
No, all I was going to say, Ilesh, is that the US was a huge market for our clients looking for external investment before this election anyway, because notwithstanding what was coming out of the White House, you know, each state was treated separately, and they've seen the US as being a great market. Notwithstanding that, I think what this is the icing on the cake, and it shows that, you know, from a centralized position there is going to be significant policy support. I think what's more interesting is what this means more broadly for markets outside of the US, and I'd be really interested to hear your views, Ilesh, on that.
That's absolutely spot on, Michelle. I think I think there will be some policy change in the US, quite rightly. I think there'll be a little bit more focus on decarbonising industry, you know, and I think the Biden administration has already made good noise around hydrogen, for example, and the supporting policy framework on hydrogen, which will I think aid that journey, you know, but I don't see a fundamental shift, you know, happening immediately, apart from the supportive noises, which is massively helpful for an international investment base. Outside of that, I think it's really interesting, you know, and I think, will they become more active in supporting that kind of fair transition argument across different economies, particularly emerging economies? So if you look at trying to decarbonize as energy intensity rises across Africa and Southeast Asia, you know, will the Biden administration be more active in supporting that journey? Well, you'd kind of hope so just from an industrial policy perspective. That makes sense. You know, I talked about that clean tech manufacturing piece. You know, that is so important to get right as an intrinsic part of the energy transition. So if you don't get manufacturing and export right, both of capital and goods, you know, you can't build a low carbon economy. So I think that's got to be intrinsic to that journey. But I haven't seen them be particularly thoughtful as yet around that link. So I'm kind of waiting for that link to be drawn by someone, which is, it's low carbon future, 11 trillion. Okay, yeah, we want a share of that. And how do we do it?
You know, Ilesh, if I could just make one suggestion, and that is, it's early,
Yep.
but the other thing to look at is the administration's emphasis on jobs. If you look through their program,
Yep.
you see it in every possible context. It's jobs, jobs, jobs. And so to the degree that the size of the market will tend to offer an opportunity for US companies, I think that's going to be a component of what they'll do. Clearly, they're serious about this. The real question is, can you embed it in not just the public consciousness, but also US law, so that this is, you know, becomes a forward trend that couldn't be reversed by another administration?
Yeah, spot on. I think the jobs argument will weigh so heavily on so many of the transition economies, particularly Europe and the US. You know, the US, as we all know, is, you know, Europe is about the same size as the US, right? If you look at it from a energy intensity, geography, you know, scale perspective, both energy economies are about the same. So how can you maintain domestic jobs in developing a low carbon fixture domestically, and how can you export that in a way that doesn't feel like, in the way that it feels like you're partnering with those economies rather than just exporting to those economies?
Right.
So wanted to turn as well to another question from the audience, which is really about we've been talking about the importance of these very large capital intensive projects, and the fact that traditional energy producers have the capital management skills and project management skills to do these projects, but investors are, you know, wary of supporting their traditional cash flow from operations, given the need to transition away from what is a carbon-based, you know, revenue source. And so, you know, will this be a drag on the pace of development, and what is, you know, how can we overcome this challenge? And I wanted to talk for a few minutes about a project that we're working on currently with a client in the US who is, and this is a carbon capture and sequestration project at very large scale. It's going to be the largest in North America if we can pull it off. But, you know, the development period is, you know, from conceptualization to in service is going to be over 5 years. It's an $850 million project. And the purpose of the project is to capture the carbon from an existing coal-based power plant, and to help this client retain the value of the coal plant that they've invested in. It still has much useful life left in it, while at the same time helping to decarbonize. And so that project is getting support here in the US, both from a new, an existing but finally really implemented carbon tax credit So there's a tax credit available for sequestering carbon. And we're also seeking a low interest rate loan that will be guaranteed by the Federal Department of Energy. That by no means makes this a sure thing. And so it's a project, and there's been similar support for nuclear, the advanced nuclear technology here in the US, with a production tax credit for nuclear and the availability of a loan guarantee from the federal government for low interest rate financing. Though that is working for the development of 2 nuclear units here in the state of Georgia. And we are hopeful that it will work for this carbon sequestration project. But it's a very long road, not for the faint of heart, and it's sort of a proof of concept. These projects are. So that's the kind of support that is very helpful, and curious to know from Ilesh, Mark, others, Michelle, what other supports have you seen that could help with these very large capital intensive projects, given the nature of the projects and the nature of the people who are trying to develop them, and the technology risk involved?
I think just on CCUS and hydrogen, my bet and or guess is, Dorothy, that we will see those technologies deployed really around clusters. And by clusters, I mean both the capture or the hydrogen production technology and the consumers being located very close by, big industrial centers, dedicated infrastructure for the storage and the transportation of either the carbon or the production of hydrogen and the transportation into the consumption of it. I think you'll see 15 or 20 of those in Europe, around big industrial centers that exist, probably the same number in the US, and then gradually adoption elsewhere, unless they're bypassing it for some reason. Australia is a great example where they may bypass it for export into Japan, for example, as hydrogen. And I think that needs 2 things. I think some of the tax benefits help, or tax credits help. And maybe there's some more direct types, support, which European governments provide both in grants or loans. I think the third thing is regulation, actually, because a lot of that infrastructure is going to be fixed infrastructure for a very long time. It's going to be transportation networks, and it's going to be storage networks. So it may well be the regulation. In fact, I think it will be that regulation needs to treat those assets differently from where the risk is. So treat them almost like low risk transmission gas distribution assets. They become very low risk, and there's a supportive infrastructure and policy sits around those. So that packages off to one set of investors, whereas the higher risk production, storage, consumer side sits with another investor that's prepared to carry those risks. And it may be there, and I think there will be 2 different types of support mechanisms, therefore, that exist for those clusters. I don't see it more pervasive than that. I think it will be based around those really hard to decarbonize parts of our industry that CCS and hydrogen will be successful, and clusters will probably be the way that they need to be enabled, rather than a pervasive network of CCS, for example, or a large-scale deployment of hydrogen across the whole economy.
Ilesh, just a question on that, though. You mentioned it during your talk, that the importance of getting outside the electricity regime to really decarbonize, and you mentioned transportation. Hydrogen obviously has been a focus of people's thinking on transportation. Are you suggesting you don't see that really getting wide use in the immediate future?
Yeah, I struggle with it outside of China, Mark. I think China will adopt hydrogen because they're making deliberate choices at either city or regional level about whether it's electric or hydrogen, and then driving it for long distance freight. I think long distance freight could be a good use case, but I think it's the 2030s, not the 2020s, before you can get a rollout of that. So I think it may be just a timing thing, Mark. And then on aviation, as you know as well as I do, it's probably going to be biofuels, in the near term. It's unlikely to be hydrogen, just given energy density, it's more likely to be biofuels that are going to drive aviation over the near term. And short distance transport, the hope, and I suspect the answer will be electric vehicles for short distance, both including domestic, consumer transport for short distances, but also fleet vehicles for local delivery. Amazon or a local supermarket delivery, will end up being and should be electric for short distance travel when it's returning back to a depot.
Absolutely. Well, maybe to throw a bit of a curveball in here, but one technology we haven't talked about at all is nuclear. I mentioned, the large advanced technology reactors, but as well, there's been a lot of work on the small modular reactors. And Mark, I know you've been working a lot, with here in the US and with our ESI colleagues. Can you talk a little bit about, what is the viability really of the small modular reactors in the near future? Certainly the technology is there, but we haven't yet seen a huge implementation. What do you see happening?
It's unfortunately not that optimistic a picture in my view. I mean, just to back up for a second, I mean, nuclear obviously has got to be a part of the solution. If you just look at the US right now, nuclear produces 55% of our no carbon electricity. And around the world right now, there are dozens and dozens of nuclear plants being built in part because they don't have an emission issue. SMRs and advanced reactors are sort of the flavor of the year, but there's a cost issue. And I think it's yet to be solved. I mean, there's not a technology issue. I mean, all you have to do is look at what the US Navy has done. They've put small reactors on ships for 50 years and they've had absolutely no issue with that. So we've got the technology. But if you look at the single company in the US that's trying to develop SMRs, NuScale, the cost of that project, assuming it does get built, is quite significant. And I think the comparison with a 1,000 megawatt plant like the two in Georgia is not all that favorable. So there's a real challenge there, I think, in deploying SMRs. It's a great idea. The Defense Department's also interested in even smaller micro reactors for their uses, but I think it's an area where the government's probably going to have to step in and do more. You do have activities going on internationally, Russia, China, Argentina, places like that, but it's sort of hard to see it becoming common without a lot of government support. And to do that, you're going to have to make some choices.
Absolutely. I had a good question from the audience about, following the whole carbon source and thinking this through holistically in terms of, if you think about the use of electric vehicles, if those vehicles are not being charged by renewable energy, and then, in terms of the batteries used in electric vehicles and the disposal of those batteries, how are countries with regulation and otherwise addressing the sort of the embedded carbon, even in some of these clean energy solutions? Michelle, you're nodding your head, obviously acknowledging that's a good question. Do you have any thoughts for us on that and others as well?
It's a great question. And I don't know if Linda, who asked the question, is from the UK, but if you are, the Telegraph did a big article on this a couple of weeks ago, and I actually contributed to it, but I was the sort of shining renewable beacon of light, I think, in what was quite a negative article, but it touched upon something that needs to be recognized, which is that just because you are producing renewable power or enabling the energy transition in some way as an organization, and as a technology, it has to be able to stand up to scrutiny around its own carbon footprint. So this is something which is coming down the line. Wind turbines are manufactured from steel, and I was listening to Radio 4 the other day, and there was somebody having a go because a coal plant in the north of England was probably not going to be given the go-ahead, and they were saying, well, look, the steel needs the coal, and isn't it better to get the coal from the UK, where we can impose all of these different protocols, and we can't be certain in terms of other countries where it might come from. I mean, I just make the point. I'm not necessarily saying that's the right view to come to. However, the point is that the whole sector will come under scrutiny and will itself have to decarbonize its production of the technologies which are being used, and those technologies after the end of life. And we have got one of these webinars specifically looking at all of this later on in the year, will also have to be sustainable. So there isn't much to say really, other than that they are going to come under the same scrutiny as everybody else, and they're going to have to comply with the regulation in the same way as everybody else. I think it's fair to say until now that level of scrutiny hasn't really been applied, but you know, it's over. It will be.
But it certainly speaks to the need, right, for decarbonization across all energy sources and across all industries. So everyone has to be doing it, or we haven't really accomplished it yet. So
the point, Dorothy, these questions are now really being asked, and they are getting profile, and therefore they will get traction, and we should expect to see as much change within our own sector as within others.
Right.
Just to comment too, in light of the U.S. political environment over the last few years, it just points out the importance of looking at the science, because these are all complicated questions, and there are a lot of embedded issues. And I think the challenge for everybody on this call is to try to come up with some objective set of indicia that we can use to reach the result we want, that strips away some of the rhetoric that you hear on different sides of the issue.
Michelle, I thought it'd be helpful for you to speak a little bit to the results of the survey that Evershed, Sutherland, and KPMG collaborated on, and you helped spearhead for us in terms of that survey. Surveyed high-level executives from over 500 large corporates around the world, and it came up with some interesting insights into the way that industries across the board are looking at the energy transition, and wondered if you could give us just a few of the highlights from the outcome of that survey, which I think are actually quite hopeful.
Yeah. Sure, Dorothy. We don't have a lot of time, so I'll be quick, and just to let everybody on the call know, if you want to get a copy of the report, please just contact us and we will send it to you. Key findings were that the majority of directors and executives know that they have to do something about this. The really interesting things that came out, I mean, the usual things about cost being a challenge, was there. But what was really interesting, and I think this is something that organisations like the World Economic Forum are dealing with now, is the fact that they felt that they didn't have the skill set to deal with, and that there was a shortage of the skill sets to actually deal with the energy transition within their own organisation. A very high percentage, well over 70%, felt they lacked the skill set, but a similar percentage felt that they would lose their jobs if they didn't deal with it. And what also was interesting was the increasing number of companies that are now building climate risk and climate objectives into remuneration strategies, and recognizing that their recruitment strategies depend on their approach to this. So a number, but in the industries that Ilesh was mentioning, actually those that are in the firing line for decarbonisation, they are very well aware that they are not able to recruit the best people, not an overwhelming majority at this point, but you're starting to see the first signs of this. They're aware that they're not able to recruit the best people because of their climate strategy. So there was an awful lot in the report, and we can share it. But I think the skills shortage is a real challenge for the energy transition within the investment houses, within the banks, within the companies that need to decarbonise, and within the solution providers, within our traditional client base. There is so much happening there, and there is so much to do, and there aren't enough people who are trained up and who really understand this to deliver it. So it's all very well and good having policy. You've got to be able to implement that policy and deliver it. And that, in my mind, is where the focus very much needs to be at the moment.
Absolutely. And I said I thought that was hopeful, because what I find hopeful in that is that executives are recognizing that lack of skill set, recognizing the need to build it. And also the survey indicated that any number of employees really do care about the carbon footprint of the company they work for. And so the younger generation, if you will, certainly younger than me, are very interested in working towards this transition. So I think those things combined make me very hopeful for the future. So I think we've run over our time. I wanted to thank our audience. Thank you for all of you who participated with us today. Those of you who submitted questions. If we didn't get to your question, we'll get back with you. Again, please join us again in March for our next in the series. And thank you again for joining us. And many thanks to Ilesh and Baringa Partners for getting us started on this first webinar. Very much appreciate it. Thank you.